We're doing record and close to record GDP. Nobody thought would be anywhere above even close to 2 when we are at 4.1, and I think we're going much higher. I think we're going to be very shortly in the 5s. And again, numbers that people wouldn't believe, but more importantly, I really think we can go much higher than in the 5s.
President Trump last night with a dinner with CEOs predicting record GDP growth in his remarks at his dinner with business leaders, leaders from FedEx, MasterCard, Boeing, PepsiCo, among others. The president touting his administration policies like lower taxes and deregulation, rolling back regs, reversing years of economic unease. Joining us now is Joseph Amato. He's president and chief investment officer of equities at Neuberger Berman. Joseph, good to see you.
Good to see you.
What do you think about 5% growth next quarter?
I think the economy has got a lot of momentum. I mean, you've seen that in the first couple of quarters of the year, and while we think there'll be a little bit of a slowdown off of the levels that we achieved in the second quarter, there's still a lot of momentum, not just in the U.S., but globally.
Should the market be higher than where it is right now, given the strength, 25% earnings growth, given the strength in the economy, 4.1%, or do you think this market is basically giving this administration the benefit of the doubt and waiting, and that's why we're not seeing a bigger move? Is trade holding things back?
Well, I think there's a number of headwinds that the market is dealing with. Certainly, the level of earnings growth has been strong, but during periods where the Fed is increasing rates, equity markets typically struggle a bit to move out of a range. And until the market sense that the Fed is going to stop and that the cycle is not going to end, I think you'll see the market be a bit choppy here over the course of the second half of the year.
Joseph, one of the things you talked about is the GDP growth. You talked about momentum. That leads me to think about technology, right? And so one of the things I talked about actually in Barron's this weekend, page M9.
There you are.
For tech is talking about how in the second quarter of the year, tech is always significantly strong. Apple, Amazon, Alphabet do really well, especially in growing environments. They're cheap on a price to earnings growth rate. If you look at that, people talk about how they're expensive. Where am I wrong in my thesis?
I think tech has been the driver of the market. I mean, if you look at the returns by sectors over the course of the first half of the year, tech has been the strongest performer, and not surprising, the earnings growth has been outstanding. And the disruption going on and the secular growth that a lot of these companies are driving are what investors are looking for. So, we expect continued momentum in tech for sure, given the strength of that sector.
Amazing.
Yeah. I was just going to quickly ask, how high can the 10-year yield go and it not disrupt the stock market? If you want to throw out a number. It's still below 3%.
Yeah, I think when you look at overall rates, they're still low. So, the increase of those rates, as we talked about, are a bit of a headwind. How high can they go? Historically, PE multiples have had a positive correlation until the 10-year gets into the 5% range. Now, I think that's a long way from here. And while Jamie Dimon may think it's going to go to 5%, that's certainly not what the market expects now. But historically, again, you had positive correlations through that.
He's putting that under his little pillow and putting his head on it and praying on it and wishing on it and dreaming on it, because it would be good for his business if you had a steepening yield curve.
What a prediction, 5%, based on where we are right now. So you don't see that happening anytime soon?
We don't see that happening, and the market's not assuming that the 10-year is going to go to 10%.
What
if you look
about
at the forward curve?
The Fed and this unwinding of the balance sheet? That's another thing.
I think it's one of the biggest concerns that I have is that for years the Fed was increasing liquidity. Balance sheet was expanding. Central bank balance sheets globally went from $4 trillion to $15 trillion of buying of bonds. So that infused a ton of liquidity into the system. And now that's starting to contract. So I think it's something we're watching very closely. The Fed is doing it very, very modestly, but still you're seeing liquidity taken out of the system.
Is that the biggest risk, or is it escalating trade tensions?
I think the biggest risk is the rate path. And if the rates go meaningfully higher, if inflation spikes and the Fed has to react and move quicker and surprise the market, I think that's the biggest risk. Trade, I think, is a headwind for sure. We've seen a bit of the U.S.-Europe slow down in terms of the rhetoric. We've seen U.S. NAFTA slow down a bit, although China's still out there, and I think that's going to extend into 2019 until we see resolution.
And what about consumer confidence? I saw that Disney came out, their attendance is soaring. You think that'll continue?
I think consumers in terrific shape, and that's one of the engines of the U.S. economy is the strong consumer sector. It's 2/3 of the economy, and we see that continuing given the labor market. Even though wage growth has been modest, the labor market's in good shape.
Sounds like you would buy stocks here.
I think we tilt toward equities for sure as a more attractive relative risk versus bonds.
All right, we'll leave it there. Joe, great to see you.
Thank you. Good
Thanks so much. Joseph Amato, Neuberger Berman.